need to move. Hey there, everyone. Welcome back to another episode of the Female Empowered Podcast. I'm your host, once again, Christa Gurka. And we have another money finance episode today with another guest, which I love because I don't know all the things about money. So I bring on the best experts in their biz to come talk to you all. So today we have Sandy Taylor, who is the vice president, senior, tell me again what you were going to say,
Senior
vice president.
financial consultant.
Senior financial consultant for Charles Schwab. She's a certified financial planner, a certified wealth strategist. She has her MBA. She's a Pilates aficionado and one of my personal besties. So all of that, that's a lot. That's a lot. That's a lot of stuff. But I wanted to bring her on because we call her the money guru in our friend group, but she is obviously very successful in what she does. And I ask her a lot of now investment questions, retirement questions, 529 college questions. And I think one of the things that I love to do with business owners, especially women, is just share information that they may not otherwise have access to. So how would I say this? Not all reality is created equal. And so sometimes if we don't, maybe our parents didn't save for retirement, maybe we don't know that much about investing. We're our own business owners. Some of us don't have retirement plans. Like, how can we plan for the future for ourselves and for our children in terms of college? Now, the one thing that I don't know if Sandy was the one that told me, but no one's funding our retirement.
Right.
Our kids can get scholarships and grants to college, so that's just one thing to consider. But I love to ask Sandy. I just actually had a meeting with her last week about my future financial status. And so anyways, what we're going to talk about today is a lot about how small business owners can plan for retirement. Different questions in terms of how do we make the most of our money that's in the bank right now? Because what do we sit it in the bank? Can we invest it? There's all sorts of options. And I just hope this is just going to be an educational platform where people can be like, oh, I didn't even know that was an option. So Sandy, why don't you give a little bit more background into, like, you've been with Schwab for a long time. You've been doing this for a long time. So why don't you give our audience a little more background on yourself?
Sure. Thank you. I'm so thrilled to be here. And of course, Christa, I am saddened we are not physically in the same room, but this is just as good. So thank you, thank you, thank you. And as Christa mentioned, I am thrilled to share. I actually just surpassed my 25-year anniversary at Charles Schwab. So that was a huge milestone for me, for the firm, and exciting to share. But within the industry, I've been in the industry now about 27 years. So prior to Schwab, I actually worked for a firm called Prudential Securities, which is the one that licensed me and did my initial training before entering Schwab. But primarily, my day to day is I work with individual investors like each of you with respect to investing, planning, talking about current situations, but also long term. And I think what Christa mentioned was paramount. And I happen to have resonated well with me because I happened to have been in a meeting last week with a colleague of mine and a client, and both of which were sharing that they had zero background or zero knowledge about investing from their own family side. And were kind of thrown into this. I mean, in the sense of learning on the fly. And I feel that is more often than not. As I said, this was a meeting with two other females last week, but it's very frequent that comes into effect. I mean, my situation is a little bit different because I came in from a family where my father was a banker, my grandfather was an accountant. So we talked about numbers. I was the numbers guru and ran numbers on a regular basis, but my grandfather had a black book that he kept track of stocks. And so I kind of understood the stock market to an extent. But again, my situation was a little bit different. And I remember my very first job out of college at 22, 23. And one of the first documents I was completing was enrolling in a retirement plan. And that's not the norm of a 23-year-old. Normally it's like, okay, how are you paying your current bills and how you're surviving, which was me as well. And I was able to contribute a very small amount, but something. And so I already knew the forward thinking about what that meant to me. Maybe not necessarily retirement, because as a 23-year-old or 20s or 30s, you're not thinking that long term, but the benefits of free money, or what that entailed to me for tax deferrals or things in that nature. Again, buzzwords that I fully understand that may be very foreign to many of you, but I also think it's just important to have conversations from an education perspective. I mean, knowledge is power. So I think that this is just, I think, a step to kind of open up conversations for yourselves, though.
Well, thank you. Yeah, I mean, my history is there was no investing coming out. I was raised by a single mom who never went to college. And so we just got by paycheck to paycheck. And even we were talking about this last week about how I was like, oh, student loans? Great. I don't need a job. The government just gave me $50,000 to a 21-year-old that has no money history. And my family was just like, yeah, you can take out loans. So it's just a very different, I think, just different upbringing, and you don't know what
Absolutely.
questions to ask. And so this conversation, I think, will be good just to get people an idea of like what is available to them, where they can go to ask the right question. So
Mhm.
can you first give us just like an overview of the difference between the different people that might be on your money team, right? So like, how do you, as a certified financial planner, differ from an accountant and differ from a bookkeeper? Because sometimes I think we get people that ask their bookkeepers or accountants about investing questions, and I don't know that that's always the best person they should ask, but I might be wrong. But what's the difference between those three?
Yep. No, I think there's a large differential between them. A CPA or accountant and a bookkeeper are going to run your numbers. So they're going to be focused much more on tax planning, on running your cash flow reports, and knowing in the sense of preparing you so that you avoid an audit. But really just the reporting side more than anything else. And also knowing the nuances as a business owner, or as an individual, what your tax situation looks like, what type of deductions you have, and how that impacts you as a standalone person. So as I said, the CPA or the accountant really should be independent of anyone from the investment side, because the investment consultant, certified financial planner that I am, I handle the investment. So I handle anything from the monetary side of how to invest the money in various types of, simplistically speaking, buckets that can be from short to long term. But also I'm in connection or in contact with CPAs because I want to know what type of tax situation are investors in, what type of tax bracket they're in, if there are any tax losses that we should be aware of. Kind of the background, the history that the CPA can provide us with, as well as from a business owner perspective, what that looks like, what type of business structure that's being reported from a tax side. But as a planner, as a certified financial planner, as a financial advisor, I'm handling everything from the investments, understanding risk tolerance, kind of time horizon for needs, but also building those investments that make the most sense and delivering those recommendations or implementing those transactions for investors. And that also would entail things that could be wealth planning, estate planning, that could be tax planning. So day to day, we're doing tax planning because if we know someone's tax bracket, for investment's sake, there are things that we want to be aware of for capital gains or capital losses. And if we're looking short term or long term, and there are different windows to know some of that too. So again, I work in concert with CPAs, but I'm never a CPA, and a CPA should never be a financial advisor. I mean, really two separate roles. And I would say a bookkeeper is typically from a business owner's perspective. They're handling everything strictly on the business side. I would say most likely you're not going to have the bookkeeper handling anything of your personal assets, and you could, but that would be kind of bookkeeping to know what your inflows are, what your assets are, what your outflows are, and what your debits or distributions or withdrawals are.
Right. And so I think, if you want investing advice and where to keep or how to make your money grow, an accountant may not be the best person to ask those questions to. Like it really should be with a certified planner.
I agree. And I would say yes, definitely, that the CPA may have your definitely will have your best interest in place, but may not know of all of the
Mhm.
investment vehicles available to you. And as I say, I'm 25 years at Schwab, and I know Schwab, very deeply in the sense of what our offerings are, but a CPA may not know that.
Right.
They're going to be aware of what yields are or different pieces, but they won't necessarily know in the sense of what options you may have or what firms have available to the investors.
Right.
And I would add to that too, Krista, the other piece too. So we're talking CPA, bookkeeper, financial planner, financial advisor. I mean, it could be, that title is interchangeable. And I would add a fourth kind of reference person, and I would say that would be a third party administrator, because
Oh,
part of that is what we're talking about today about retirement planning. And a third party administrator is, I would definitely say, quite imperative to this team for business owners that are looking at business retirement plans. Now, that person is completely different than the CPA or completely different than myself, because they're going to come into the mix, one, to be able to assess if, in fact, a small business owner is looking to start retirement planning and has employees and needs to have essentially what's called a census done to
mhm.
know what the company looks like. How many employees, how many full-time employees, how many seasonal employees, who's eligible, and what the objectives are. So again, that's kind of separate than all of these, because the third-party administrator is also going to do the reporting that has to be done on the retirement plan, separate than you as the employer, separate than you as the employee, but still for the plan itself, which is kind of a separate entity per se, if you have a qualified retirement plan that requires reporting.
That's great. Well, that was going to be our next question. So we get this from a lot of the business owners as part of a hiring strategy, right? Like, how can I recruit and retain top talent? And one of the ways is offering some sort of retirement plan. So, what are the options out there? And mind you, most of our listeners are small businesses doing less than $1 million in revenue, have anywhere from 3 to 15 employees.
Mhm.
So what are the options for business owners that are out there?
Okay, so and even of the 3 to 15, it will depend on if they're considered employees or if they're independent contractors. But I would say this typical offerings for small business retirement plans would be, the first of which that I think of is a SEP IRA, which is a self-employed retirement plan. SEP IRA, that would be for an employer and maybe their spouse, and that allows for larger contribution limits in the plan itself. And it also offers a traditional SEP IRA or a Roth SEP IRA, and I'll
Mhm.
kind of highlight that in a minute. But I would say a SEP IRA, an individual or solo 401k plan. Again, if we're talking about a business owner and maybe their spouse and very small amount of employees per se. And the other of which I would look at as an option would be a simple IRA account. Now, the individual 401k or solo 401k and the SEP IRA, they offer the Roth and the traditional versions. A simple IRA does not yet. That's something that is in conversation. We anticipate probably next year, in the next 2 years. So if in fact the objective is what we call after tax dollar contributions, where the money grows tax free, which is the Roth version, that may be reconsidering. But those are the three main types of retirement plans that I would focus. If in fact, even to keep it more simplistic than that, and they don't want a qualified plan per se, or they're kind of starting out and it might be the first step, it could even be an individual IRA account, which is a whole other option. And that's not necessarily as beneficial for a business owner, but it's something to at least get started with.
Now, do all of these require that you offer it to all of your employees? It's like all or nothing? Or is there one like if I, as a business owner, don't want to offer it to my business, but I just want to have my own retirement fund?
Yep. So great question. If it's a qualified plan, so particularly the simple IRA account or even a 401k plan, it has to be offered to full-time employees, and there will be what's considered a discrimination assessment done of the employees, the staff, a census done to know who's full-time. So you would have to offer it. If in fact you said, I don't want to go into that offering and be able to do something that entails contributions for the employees and matching contributions and things in that nature, then I would say an individual retirement account, an IRA, lower contribution limits than qualified plans, you can contribute if you're under the age of 50, $7,000, or a catch-up benefit of another $1,000, so $8,000 per each calendar year. And contributions can go out till tax filing deadlines. So you have a little bit more flexibility, but that's an individual retirement account, not tied to a qualified plan, and definitely not required to have to offer to employees. But the others, you will have some requirements, particularly if you're setting up a qualified plan per se. I mean, again, that's why, again, I bring up the third-party administrator to do a census to see what your company looks like. If, in fact, you have part-time employees or seasonal employees that don't reach the required hours, there are qualified plans that you could still consider and roll out, and they may not be eligible. So then you bypass that option of requirement for the
Right.
employee.
So then it's also true that if you don't offer that, an employee of yours could also have their own individual retirement account that they draw directly from their paycheck, correct, into their own retirement account.
Correct. So any individual can have a retirement account, just that, an individual IRA account, and they can have it as a traditional or Roth and be able to establish it or open it in any way, shape, or form, meaning at a brokerage firm, at a bank that offers retirement accounts, and they can make their own contributions. I've even seen cases where a small business owner looked at the creation and said, I'll for a bonus or for a contribution. I've had employers actually make contributions into their employees' individual retirement accounts instead of rolling out a qualified plan because they didn't want to offer it across the board. They just did it to selective employees as, let's say, a bonus per se.
Interesting. Okay, so let's go back to qualified plans that are offered by a company, right? What are the differences? So you talked about a 401k, which is a little different, I believe, than a traditional IRA. I might not be correct, but anyways, what are the differences between those programs? And like, what would be some things to consider if you are going to offer that as an employer, which should they choose or which should they be looking into?
Sure. So a qualified 401k plan is offered where it does require assessments done or discrimination testing that has to be done on I believe it's every 2-year basis. And there are reporting measures that have to be made for tax purposes. So 5,500 tax reporting, again, these are kind of numbers, but additional reporting that has to be done. So a qualified plan offers an employee to make contributions off of payroll, where they can make a percentage of what their income is, but then the employer has to do a matching of a certain percentage per their income each year. So that's a requirement for every eligible employee. Now, every eligible employee, the employer is going to set that up. Now, the employee can say, I don't want to sign up for a qualified plan. So they're not required to have to enroll in the qualified plan. It's usually a benefit, though, particularly for longer retention of those employees. And it is free money if they're giving you a matching up to a certain percentage of your contributions. So if an employee makes a contribution of 3% of their income and the employer is also making 3% contribution, that additional 3% is free money. So
can you give like numbers? Like say an employee is making
$1,000.
$70,000 a year.
Okay. So I'll use, I think I'll use it. I'll just say that let's say they're making 60,000 and so $5,000 a month, and they're contributing 10%
Of their salary.
of their salary.
Okay.
So I'll keep that easy so that, and I don't know, that might be excessive. I'm not sure. But if they're $60,000 income, contributing 10%, so I'm just using numbers, $5,000 a month. So that means their contributions are $500 in the sense of each monthly contribution that's going pre-tax or in a Roth contribution sake after tax. So either that $500 is not going to be taxed on payroll until they take a distribution later in life, or they're paying taxes now, but that $500 contribution is growing tax-free every month. So that's the $500. Now, in addition to that, the employer will do a matching. Now, the employer may do a 3% match. So even if you look at that and you say $500 is your contribution, then the employer is doing another 3%, which is $150. So that $150 per month is free money. So you're contributing out of your pocket as the employee $500, but really $650 a month is going into your retirement account. So
Makes
that's
sense.
one piece of the contributions. Now, the second and just as important, if you're making contributions, is then to make sure that the money is being invested. So that's a second step, but that's probably one of the largest, what I would say, pitfalls that happens is implementing the plan, making the contributions, but then investing that money. And investing that money, the account has, let's say, an umbrella over it, whether it's pre-tax or tax deferred, so that you're really taking those tax benefits now and then as an employee. But then at the same point being, when you take the distributions, you're going to be taxed as ordinary income. Or you say, I'd rather pay the taxes now on that $500 that's growing, but later in life, because I've got longevity, when I go to take that out in 20, 30, 40 years, whatever that looks like, that money has grown and now it's coming out tax-free. So you pay
Would you
tax.
would
Yes.
you say, sorry to interrupt you,
No.
I guess it just made me think of a question.
Yeah, sure.
So would you say if someone is young starting this and has this opportunity and they're in their maybe 20s, they're most likely being taxed at a smaller at a I can't even think of words.
Lower tax bracket.
Lower tax bracket, thank you. Then if they go to take it out when they're 65, they might be at a higher tax bracket. So do you do that kind of like advice to people of like, I mean, you never know what's in the future. You can't tell 100%, but would you say someone in their 20s might be better to pay the tax now rather than when they take it out when they're older in life, or it doesn't, not necessarily?
So I do give the advice. It depends on, so I'm going to kind of extrapolate this a little bit into two different pieces. So first of which is, as an employee, and you say a young employee and someone in their 20s, they're at a lower tax bracket than, like you said, later in life. If in fact they're willing to pay the taxes now on the money, there's two benefits. One of which is, if they are at a higher tax bracket later in life, then that does benefit them that they paid the taxes in the front end. In addition to that, we're talking if someone is 25 years old and 40 years later at 65 years of age, they start taking those distributions, meaning the withdrawals from the account, that money, that $500 a month or $6,000 a year, and then obviously there's the additional contributions from the employer, but all of that money is now growing year over year on a compounded rate and tax-free. So yes, if I just use simple math and say $6,000 a year and then look over a 40-year range without any increases, that's $6,000 every year over a 40 years is $240,000. Now that's just simple math of saying dollars to resulting in the future. That's not the case though, that I'm looking at it overall, because obviously you want growth and you want that to be able to have a stronger rate of return over the many decades. But if you pay that taxes every year, that 240,000 later in life, which will be much greater than that because of the umbrella that you've been in, you start taking that money out, it's tax-free. Whether you're at the same tax bracket or you're at a higher tax bracket, it's a greater value than what you started with that you pay taxes on. And as
Understood.
long as you have time on your side, then it does make sense. The biggest Achilles heel is if, in fact, you're at a high tax bracket at a younger age, and I think of myself when I first started in the industry, and it used to be, oh, when you go to retire, you're going to be in a lower tax bracket. So don't worry about getting the tax benefit now. When you're retired, what type of tax you're going to be paying from Social Security and then minimal? Well, the differential is exactly this point to say, this money 40 years later, you're probably going to be at a higher tax bracket because you start taking that out as ordinary income. It's probably going to keep you at a higher tax bracket. So right. It makes more sense if you've got time and if you foresee yourself to be at the same tax bracket or at a greater tax bracket, it definitely makes sense to pay the taxes now versus later. If in fact you already know, and like you said, no one has the crystal ball, no one knows the definitive future. But with that being said, if your time horizon or time range is closer and you definitely know, oh, I'm never going to be in a lower tax bracket and I want the tax break now, then go ahead and take the deduction now and know that piece. But there are some other areas to consider with this too, because it does become, I bring up Social Security, but you don't know necessarily if there are other events that happen which could
Mhm.
impact tax situations and
Mhm.
keep you at a higher tax bracket for even longer periods of time too.
Right. I mean, this is just my assumption, but I don't know if Social Security is supporting many of us that are listening to this conversation right now, and certainly not our kids.
Right.
So, yeah. And you're right, over 40 years, a lot can change, right? If you
Correct.
start young. So, can we just speak to that really quick? If there are young, even instructors, not business owners, or even young business owners out there right now,
Mhm.
like that are in your 20s or in your 30s, and I recognize, because listen, we were all young and broke back then. Like we were, trying
Living
to,
paycheck to paycheck. So it's hard to say,
literally, I
can I
get
carve
it.
anything
So
out for saving for longer term?
what would you, just from your aspect, right? It's like when I look at people from a movement perspective, I'm like, if you just start this little thing now at 20, by the time you're 65, it's going to be so much different. So what can you tell younger people in terms of that are really like, I can't afford $25 a week? Like, what would you say to them so that like they could see the picture of how this can change the trajectory of their ability to retire if they start younger?
Yep. So I would say first is you're right. It becomes one of those to specifically say adding another bill in the mix or adding another expense when you're truly living paycheck to paycheck becomes a challenge. No question about it. But I would say even if someone can assess their overall financial picture and say, even if it's $10, even if it's $5, whatever that might be, to get into the habit of the routine of making a contribution, I would encourage that. Because the earlier the better. The longer you wait with respect to starting any sort of retirement planning, the more that becomes a catch up timeline. I can recall I was in a bank in downtown Miami, and I won't forget this. I mean, I was 24 years old and I was working at Prudential Securities. I walked in and the banker had this chart and like a gliding chart, and it said, if you want $250,000 at age 65 and you're 25, contribute this every month. And then you saw at 35 years of age, at 45 years of age, and at 55. So the closer you get to that, if you're talking 40 years, you've got time and you have more flexibility. And I emphasize the flexibility because you don't necessarily, you're not required to have to make a contribution as an employee or as an individual investor. You can manage each year to see how that works for you. But I think to start with a very small amount that's affordable. I mean, my number might have been excessive to say 10% off 60,000. It might be 1% off 60,000. And even looking at that to say, how can I get there? And the overall basis of really a timeline perspective. But if there are years that you say my priorities are really shorter term with some of these, like buying my first piece of real estate or a child, or even as a business owner, to say, I'm just worried about getting through the year, the calendar year from a tax
Right.
owner, from a business owner. So I would treat it as, I know it says you don't want to look at, oh, adding another bill, but I do feel that's very imperative. I think you put yourself, when you list your itemized expenses, I think your name should be right there as a bill, as an expense, and you decide what that amount is. If that's $10 a month, I mean, there are pieces that come out to say if you cut out a coffee a day or things like that. I don't know. I mean, there are certain things that people can do to manage their budget, and my job is not to put people on a budget by any means, but my job is to make sure that if the goal is that they want to retire at a certain age and be in there's financial freedom or independence, that we're working toward that. But it's not a static type process either. I think that there are things that do happen, meaning events, life events that happen that can be more flexible at times and may not be. So I say monthly, but even if someone looks at this and says, I take on a second job that's seasonally, or I use a annual bonus or things in that nature, then I would just treat that as that's my contribution for the year.
Yeah. It's really looking at like, um, long term. return versus short-term gain, right? So like I could take that bonus and buy a new pair of shoes, or I can invest it and maybe buy a new apartment by the time I'm retired, right? So
Yes.
it's a mindset. And it also, the younger you start, the more chance you have for the like the volatility of the market, right? Like you can be
Correct.
riskier, which has higher upside. So there's a little bit of a benefit to that. And again, this is like I never had these conversations with my family ever, ever. So the thought, it was just very foreign to me. And nobody was telling me one, my son who's 21 already has a brokerage account, and my younger son, he's all, I told you, into like crypto a little bit, but he did say, can I take my extra allowance and invest it so that I don't spend it? So we are
Right.
talking to them about just like even putting it in their back of their head of like, I could save this now and it will be worth more later, hopefully. Hopefully.
So I
We don't
think
all
so.
have
A
to go
couple
live in
things.
Gilead.
Right, right. So I think a couple things you just said that are very important. I think the first of which is I'm going to start with the last one that you just said about your youngest son Derek. I said I want to come back as him in my next life,
Don't we
but
all?
he's living his best life by all
Yes,
means.
he
But I
is.
would say that's very common. Your comment about Derek saying I don't want to keep this money in my checking account or in my bank account because I don't want to spend it. So I think it's the structure of it's mind over matter and
Mhm.
it's what works for each individual. So we're talking about retirement planning, but even in the fact of if someone looks at their bank account every month and or they keep track of it for a month or a quarter, or, 6 months and see that there are discretionary expenses that just happen to be, oh, this was an extra $10. I didn't think about it, or they, were able to identify something that could be the difference between checking account versus savings account or
Totally.
checking account versus retirement account. I think that's one major factor because I see that all the time or talk to people and I say, okay, what is your cost of living or what are your expenses per month or per year? And someone will, and I know if they're prepared or not because they'll use a number, they start itemizing a few things, but then I add in additional pieces that I already know should be on a monthly or quarterly budget. And then you kind of see these, as I say, discretionary expenses that, oh, I didn't realize that this $100 a month or this $200 a month or where they could have saved a little bit or made, again, carved it out. So I think that's imperative. The other that you mentioned too was everyone has a difference in the way they look at things. I mean, I've always been this type of person, but as a certified financial planner, my life revolves around planning, meaning that I'm always looking at the long term aspect. But my one of my bosses told me this, and I thought it was very important at a certain point where he kind of broke something down, and he was like, "Live in the days, work in the months, think in the years, and plan for the decades." So
Mhm.
you're really looking at to say you're living now, and so as I mentioned, my goal is not to put people on a budget. My keep living your life like you are every day, and you're looking at it from the sense of each month and each year. But it's also saying to plan because things will come up quickly. I was on a call yesterday with a very long term, actually my longest. I've known this girl since the day I was born, and we were talking about our age now in our 50s and saying, okay, transitionally speaking, what's the next step? And she knows that I've been at Schwab 25 years and this, woman's been at her company 13 years. And she was like, I need to get to age. She said, I go through some days I don't want to work another day. Sometimes I look at this and I know I've planned it and she's 53. So she said, I just need to get to age 56 because then I know I have health care
Mhm.
for myself. And so she's kind of looked at that. And we were kind of having this joking conversation yesterday. I'm like, there are days I'm sure that are very tough for her where she said, that she doesn't want to go back to work the next week. And I'm like, carve it out. Look at your timeline to say 3 years really is 36 months. And then you can, break it down into days or whatever that looks like. But target some of those to specifically say, all right, if I can get to that number and she'll recreate it. Maybe at 56, she stays another 10 years, maybe not.
Yeah.
But at least it gives her the
The
freedom.
choice, the
Correct.
choice. You have a
Exactly.
choice. Yeah.
Yes.
Instead of having to do something, you're,
Exactly.
so if you can be like, yeah, I don't have to work anymore. I'm choosing to work now, right?
Correct.
Or maybe you'd say you take on a passion project. Maybe you're like, I mean, both my dad and stepmom and Scott's mom, they worked for the state of New York their whole life. So they got phenomenal pensions. It
Right.
actually cost them money to keep working after 55.
Right.
So they both technically retired and then started consulting, right? And so, but it's also, I think it's put yourself in the room sometimes with people that are having the different conversations. Because you remember this, we laugh about it now. But I think it was like 20 years ago that we were all talking about retirement. It was before I had kids. And I
Right.
think somebody was like, oh, I think I need $3 million to retire. And I thought that they were batshit crazy because I'd never even, the thought of $3 million to me at that time was so asinine. Like the
Right.
thought of $1 million, I was like, who would need more than $1 million? Like, I can't even believe it. But again, if you're never in a room, if you're never
Correct.
around people that are talking in terms of millions or investments or real estate, it becomes so foreign to
Yeah.
you that you don't even understand. So, like, the thought of $3 million to me at that time was like, you are like a gazillionaire. Like, I don't understand how you need that so much money. So, I do
Yep.
think it's important to have these conversations with people and recognize like just because it seems doesn't mean you don't have the capability to like have that available to you.
Correct. I mean, I think one is, as you said, be present with respect to kind of engaging in the conversations. Don't avoid them by any means. But I also think the same factor, and that comes into personal situations too. I mean, that comes into couples and family
Yeah.
situations. So we're talking about small business and retirement planning, but I will definitely say that I see this very frequently that there are, one dominant individual that handles the finances in the family. Typically, I see much more of
A
that
man.
women are handling the day-to-day expenses, like paying the bills and things in that nature, or set up on auto payment, things like that. But the husband, the male spouse, from my experience, has been 9 times out of 10 the investor, the one
Right.
that's really looking at it. And I don't know if it's they're looking at it from the provider perspective or they take on that role. I've had women in my office
Or
before
the
that have
woman abdicates that role. They're like, oh, this
correct.
isn't for me. This is, I don't understand. I don't understand.
Correct, correct. And it's been interesting because there have been times that there's a life event that happens, and more times than not, the surviving individual, partner, spouse, whatever that might be, if they come in and they were not engaged before, they either become much more engaged or they fully acknowledge it and say, I made a mistake by not asking more questions earlier on,
Yeah.
which is very interesting. I think in a let's say in a personal situation, but I also say that comes into play on a retirement side. There are so many people that say, "I didn't know that my company offered this benefit,"
Yeah.
or "I didn't know that this was available to me as a small business owner." Whether I want to offer it to my employees and from the company's perspective, or whether I just want to be self sufficient and really prioritize myself. Absolutely,
Yeah. I think those are important facts. And so just kind of like closing the circle on
yes,
retirement, two questions. If a business owner is interested in just maybe not for their whole business, but they're like, I really should start setting up a retirement fund for myself, who should they reach out to?
financial advisor. So
Okay.
that should be their first person that they should reach out to. And if they don't have a financial advisor, I mean, obviously, as I say, I'm 25 years at Schwab. I feel like every investor should be at Schwab because we're, a large powerhouse in the industry. But individuals can go right online and open up an account. I mean, I know Schwab's platform, and I know individuals can open up right on our website. But in general, I mean, the other alternative could be if they would have a banking relationship, so they can open it up at a bank to at least start the account at a bank. You might be more limited with your investment options, but you can still invest the money. You just don't want to keep it. You don't want to put the money in and then just let it sit, meaning in
Right.
cash or in money market, because that's not optimal over, like we're talking about, longer periods of time. But I would
Can they just
say
call like the 1-800 number for Schwab and say, I need a
absolutely.
financial planner?
Yep, absolutely. So they can go to they can go to the Schwab website, schwab.com. They can call our 800 number, and definitely they can look at what's most convenient for proximity where they're located. We
Okay.
have over 300 branches across the country. So and then if a branch isn't convenient, definitely over the phone, whatever that might be. I mean, I can provide my contact information, even direct them to, someone that's local to them as well. Absolutely.
Great. Okay. So let's transition now out of retirement
Okay.
and just the options for business owners in terms of making the money they have in their business work for them in their business. Because I think that a lot of people, well, and I was confused about this for a while, but I think a lot of people are very confused where they're like, okay, they have all this money in their business, they have a profit, $50,000, and they're like, oh, I'm going to invest that $50,000 in a high yield savings account. Those are the biggest things now. It's liquid, it's safer. pretty decent interest rates. But what
Right.
they do is they take the $50,000 from Pilates in the Grove and they take it individually and then they put it in a high yield savings account under Christa Gurka. But that money has now just been taken as a distribution. So now you're paying taxes on, et cetera. So
Correct.
what are some things as a business owner that businesses can do to help the money that they have in their business, the savings we talk about them having? We also recommend they get it out of their operations account because then they're like, oh, look, I have an extra, let's buy an extra reformer when they don't necessarily
Correct.
need it. So, what are some options in terms of high yield savings accounts? You said they could even open a brokerage account in their business name and be investing it. So, what are some of the things they should be thinking about in those terms?
Sure. So I would say first is within that operational account, look at what they need to keep liquid for
Right.
them immediate. So that might be, as we said, kind of that thought process of current within months. So it could be 3 to 6 months of cash flow that they keep in that operating account. Now, the next step is what are their priorities? If their priorities are reinvesting in the business versus keeping some form of liquidity, then the reinvestment in the business can still be twofold. I mean, a small business owner can open up a corporate account, whether it be a corporation, an LLC. They can open up that type of account, that structure for tax purposes, without taking a distribution, meaning out of your example, Pilates in the Grove, taking it out of Pilates in the Grove to you as Christa Gurka, you keep that in Pilates in the Grove, but you can open up a corporate account. You can open up a business account with a brokerage firm or a bank and put the funds in there. Now, I continue to emphasize brokerage because you have more flexibility with investment options with a brokerage account. So the operating account is already a checking account. So that's
Mhm.
already getting, very nominal, very minimal interest per se. Any money that you carve out, still keep it in the ownership of the business, still in the same tax identification number. Because once you move it from the tax identification number, like you said, distribution, what that would look like as a taxable event, it's not necessary. And I'm
Right.
going to make an analogy to that with a retirement account after this, though, to kind of backtrack. But I would say open up a business account. My preference is at a brokerage firm. And then you have the options within that business account. It's considered open architecture. So you can, if the objective is keeping it liquid but earning greater interest for emergency needs or for reinvestment in the business over the next period of time,
Can you
24
explain
months.
what liquid means in case somebody doesn't understand what that means?
Sure. So liquid means that they could have it in a security that doesn't really fluctuate in principal value, but is available to them immediately or next business day via writing a check or a wire transfer. But liquidity, even if you invested in a stock or a bond through a mutual fund or exchange traded fund, meaning investing it further, it's still liquid next business day, but you have flexibility on the value.
Mhm.
So if there's volatility in the marketplace, um, and you end up with respect to investing in a stock and the stock drops 10%, so your $50,000 is now worth $45,000. So that's still liquid, but now you've got a loss. An illiquid asset, that would be a CD or a bond that you lock it in for a period of time that you can't sell out of. A bond you can still sell out early, and a CD, if you break the CD before maturity, then you have a penalty. So a CD is illiquid for that period of time, which is why I say nothing against banks, but unless they have a brokerage arm, an investing arm attached to the bank, then you might have limitations. So
Right.
even if you carve it out of the operating account and you put it into a second account, if it's at a bank and they say, okay, invest it in a CD for 6 months, what if you need that money in five
Right.
months? It defeats the purpose. That's what's considered illiquid because now you have to hold it for that full 6 month window.
Yeah.
So a liquid asset, I would still say, is anything that can be sold the next day or the next 2 days, and there's no penalty. That's one. But also understanding the money that you carve out, what the objective is for that. If it's strictly to know that you want to have it, as we say, liquid, but you don't want principal risk, then a money market, money fund, something in that nature, or a very short term investment option on the fixed income side makes the most sense. If you're saying part of this I can grow then it could be looked at as something more growth oriented. There's much more upside potential, but there's more downside risk if there's volatility in the marketplace too.
Right. Do you recommend, I guess it varies business to business, but because businesses tend to probably be still shorter term than longer term, like the idea of like a person being in their business for 60 years is not
Right.
as normal anymore.
Right.
Do you still, if you're going to invest some of those funds, would you recommend to people more on the conservative side because they might have to close out this account or take the money out in a, you know, in a shorter period of time?
I do. I would say, I mean, just on a simplistic piece, even within the same account, I would look at that as bucket planning. So
Okay.
it can still be of that amount that you have in that investment account or that longer term account. You may earmark part of that. Say, I still need part of that within 12 months or within 18 months. So that's going to be the most conservative or the most focused on capital preservation versus money that we might have a 5 year or 10-year time horizon on. You're right. I don't see as frequent of a business that says, I know I'm going to be around for 40 years because you have no idea. But it's also one of those to avoid taking on undue risk either. You hear about the stock market or you hear about things to say, I know that I want to grow the money, but I don't want to necessarily take on that undue risk that I have. You mentioned cryptocurrency. There's a lot of volatility with crypto. So you could be at any gathering. I mean, I hear it and I know when I ask clients, I ask them a question like, where did you hear this? When they bring up a certain stock or a certain type of investment, or saying, I know I want this type of rate of return. Where do they hear that? It's usually from a friend, and you always hear the best things, but at a friend gathering or something, people aren't bragging when they've lost money. They're bragging when they've made money. So it's the same thing as going to the casino, though. You've got the flip,
Yeah.
50-50. If you're investing from a growth perspective and not managing that or not diversifying. I mean, our word is diversification, but not diversifying it, meaning in different positioning. So some of that money can be ultra short to intermediate term to longer term. But even now in our basis, I used to say in the first 3 to 6 months or 6 to 12 months for emergency funds. But we've even looked at things to say if you need money within the next 2 years, you don't want to take on much risk.
Right.
And I say take on much risk, meaning I wouldn't use the word growth at all. But I have clients that tell me I'm very conservative with my investments. And when I see a statement or when I actually define that further, we drill down on what conservative means to someone. They invest in 20 stocks that are well-known companies that what we call blue chip companies, but there's tremendous risk there versus being in a money market or in a money
Right.
fund that's just focused on capital preservation or being with a bond that is giving interest till maturity. So I think all of that. But I would also say that it depends on what the needs are. So what you may be focused on is going to be different than a different business owner. So I wouldn't say there's a one size fits all.
Yeah, for sure. And why it's important to speak to a professional that can give you all of these options, right? Like, I mean, I remember for our 529 plans with our kids' college funds, as they got into high school, we kind of were like, we really want to go very conservative right now because we needed to pull that money out in the next 3 to 4 years. And
Yep.
if the market took a big nosedive, it wouldn't be enough time to like recoup that money. But obviously, when
Right.
they were in preschool, we were like, let's high risk. We had 17 years to like turn it around. So, but again, talking to a professional like you who knows what's coming down the pipeline and really understands how you can diversify so you can keep yourself safe in one area, but give you all the options of like where you can afford to grow, et cetera. So,
Agree. It depends on time on your side. And then meaning, like you said, 17 years versus 3 to 4 years, time on your side, you have the ability to ride those flows, that flexibility, that volatility makes much more sense. The other piece of that also becomes what that comfort level is with risk.
right.
My level of risk could be quite different than yours or anyone else's. And I say that factor because I know plenty of investors that are much younger than myself that have shared with me that are very conservative because they've kind of seen some things their parents have experienced through the financial crisis, through the dot-com bubble, things in that nature, that they just are more concerned or they've seen, if financial events happen. So
Mhm.
they're more conservative than maybe prior. But I also see it's kind of bifurcated because I also see others that are willing to take on much more risk, understanding this is money they're not going to touch for an extended period of time. So, yes.
Yeah. Where do you put real estate in people's portfolio?
I would say that's still amongst the balance sheet of assets, but it's an illiquid asset.
Right.
So that's something because your home, what you live in, obviously you need to have a home, but what you live in, there's a value to that. The bricks and mortar, you can see the physical house. So it's still an asset. You still look at that. Now I would look at that asset of over net worth. You're still going to take the liability, which is the loan you have. If you don't have a loan against it, then it's strictly a straight asset without a liability, taking it from the balance sheet. But it's an illiquid because you're not turning that home into currency today. It'll
Right.
take you time to sell the house. And that, even at the strongest market, it could take 5 days, but it could take months to extend it. It could be years. But I still say it's part of that balance sheet, but it would be real estate would be its own asset,
Okay.
uh, but an illiquid asset.
Yeah. Do you think it's as volatile as the stock market? More conservative, less risky?
So I would say real estate is not as volatile as the stock market, but you have less liquidity. In the
Right.
stock market, you could literally, I mean, we're talking right now, but I have until 4 o'clock today to place a trade for anyone today that wants to get out of an investment. So we don't have to. In a mutual fund, the sale happens or the purchase or sale happens at the close of each business day. So even if someone is real concerned or needs liquidity or is planning something, the trade can be placed by close of business today. Again, from a home perspective and tying money into your home, not that it's not worthwhile or of value, but when individuals have all of their money tied into real estate, then my question becomes, okay, where are you going to, if you have to repair a roof or
Right.
there's a structural item or even a renovation, whatever, where's the money going to come from? And as long as amongst that pie that you've got a piece that's real estate, another piece that can be investment or liquidity or easier access, then that makes sense. I mean, there are other components. You can do a home equity line of credit. You can do
Right.
a pledged asset line on a brokerage account. There are ways to access money, lending against assets, but I just bring that up.
Yeah. So let's talk a little bit about kind of what we talked about in your office the other day, because our Danielle, who's like the bookkeeper in our mentorship group, she always talks about holding on to your money or paying things out. And you and her and my husband have the same thoughts, whereas someone like me, and I think the conversation I've had with Danielle is just then I've had to take so many loans out for school, like debt is just, I don't know, it is weird in my mindset. Like just looking at all of the debt, even though people like you and people like my husband are like, but it's good debt, right? So I said to you, I want to pay off my student loans. And yes, I've been 20. So you started Schwab the same time I graduated PT school. So it's been 25 years.
Right.
And you, along with my husband, along with Danielle, were like, well, I might not do that. Even though to me, the mindset is like, I just want to pay them off. I want to be done. I don't want to see them anymore. But can you speak a little bit? Because I think a lot of my listeners are similar to me, where
Mhm.
they wouldn't consider themselves risk averse. I think they'd consider themselves debt averse, but how you can look at it from a different perspective.
Sure. So, and again, and there are different pieces of risk averse versus debt averse by all means. But a debt averse, even if you look at this and say, is it good debt versus bad debt? So, as you bring up, a student loan is not considered a bad debt. We don't look at student loan as bad debt because that's just a period of time that you're going to be paying that loan back. Um, I would say bad debt or something that's going to work against you will be credit card debt. And the other component of that to look at as you're assessing, again, we talk about liquidity. If you have money in a checking or a savings account, I mean, I look at this much more of savings or an investment account, I would prefer to say, because even in the sense of money markets right now, or our money markets are yielding over 4%. I would rather, and that's just money markets, if we then go further than that and invest in something that's growth oriented. And over this 25-year period, Krista, as you brought up, your student loans, had you paid that upfront versus invested the money for yourself, meaning you still know you're paying that debt, every single month, meaning the student loan. But then separately, instead of paying extra to pay that down faster, then you save money. Even if you said, okay, I have an extra $100 a month, I can either pay down the student loan and my interest rate is X, or I could invest it. And even with respect to the stock market, and there's market cycles, but if I look at a diversified portfolio in the marketplace, a balanced, diversified portfolio over many market cycles, that return might have been greater than 8%. Again, I'm talking over a 50-year period. So I'm not saying year over year that you're always getting the 8%. And that's very balanced, meaning there's been exposure into the equity and fixed income. We've gone through recessions, corrections, downward, volatility in the marketplace, tremendous growth. But you look at that and say, all right, my art of compounding and my growth side paid off much more so that I still paid this debt, not bad debt, but I also was able to save on the other side. If in fact I have credit cards that are interest rates of 15, 20%, then I'd say, absolutely, let's tackle that because those are going to be greater in expense to you than the return you can get on an investment.
Right.
But it looks at that itemized to say, overall, bifurcate it to focus on, I'm still going to focus on paying down my debt, not bad debt, but I'm also going to save on the other side or invest on the other side. We say that about that liquidity conversation. You pay off your student loans, great. You need the student loans to get the education you have. But at the same point being, now if something comes up and you need cash, great, I paid off my student loans. I don't have that, backpack any longer, but now I need 20, 30, $50,000 for XYZ repairs or business investment or things in that nature. I don't necessarily have that because I didn't create that savings, that investment, that growth account.
Right. Yeah. It's definitely an interesting way to look at it because you're like, well, if my loan payment is 5%, but I'm making 8% in the market, relatively speaking, it's like I'm making more by investing my money.
Correct.
So
You are, and you also look at that again, compounding situation too, because as things are growing over the course of time, it's not just that 3% spread between what you're paying on interest and what you're also earning, because you have that compounding effect. So that
right.
there is one small piece in there, and this is what we talked about the other day too. It also depends on your comfort level. Like if someone's saying this is a major monkey on my back, I no
Right.
longer the student loans are just so overwhelming, then that's one piece. But I would probably suggest for folks that have multiple student loans, consolidate them first into one loan, or see what could be consolidated into one that's a fixed rate, and kind of focus from that and know that that's one side. I would probably say 4 or 5 years ago, when interest rates were essentially at zero, money markets were essentially at zero, but then interest rates on student loans would have been pretty low too. That I would still rather have some growth in that, let's say mix, besides just tackling paying off the student loans.
Yeah. I mean, it's not a monkey on my back. I don't even see it. It's an automatic deduction, but it's one of those things that's like a milestone of some sense. I was just like, it's been 25 years and how am I still paying money back? But yeah, I get it. So, all right. Well, I want to be respectful of your time. So if there are women listening that would love just even to educate themselves a little bit more, or like you said, you did advise, maybe they can just call a Charles Schwab office, speak with a financial planner. Can you also mention it? Like, it doesn't matter how much money you have, just like
Correct.
having that conversation is important. You'll reiterate that, right? It doesn't matter. You
Exactly.
don't have to have tens of millions of dollars to work with a broker.
Right. So I would say a couple things. One of which is the reason why I'm at Schwab and the reason why I've been here 25 years is that we focus on our clients, meaning seeing investment, seeing investing, seeing planning through their eyes. So client focus is our priority, and that can be someone that's 21 years of age. That could be someone fully in retirement. I mean, the full gamut. We deal with complete broad range of investors, from starting investors to those that are a life event happens and they come into money, or vice versa. They're distributing all their money or dispersing all their money. Schwab offers, but many firms do offer for any type of investor. And I think that it becomes, you want to focus on making sure that you're talking to someone that's out for your best interest, not their best interest. So a question I always suggest people ask is, make sure that the person they're talking to, they're going to know, because I know when people ask me that someone comes in and is not too familiar about the industry, they'll say, are you a fiduciary? Now that's a very important word though. And as a certified financial planner, I have to do ethical ongoing ethical training and certifications for continuing education because I have to work in the best interest of each individual investor. What that means, or kind of to dig into that a little bit further, is that I'm not here to focus on Schwab or myself or prioritizing selling a product or things of that nature. I'm prioritizing what's in the best interest for each investor. And it could be at any range. That's the great opportunity for investing is you can have the smallest amount of money and be able to go into partial shares of an investment without having to have millions of dollars. But there are also things that happen over the course of time too. And I would also highlight something that was important. We were talking about business owners and saying, taking money out of your business account and ultimately putting in your own ownership and what that taxable event is. That also becomes the effect of as people are listening to this or thinking about themselves, or even as a couple, I would suggest sit down and kind of write out what your current assets are. There are things you're going to overlook or miss or not realize, and they might be former retirement plans. They might be other accounts that you started when you were single that are, were not morphed into your couple's centric situation, or even in the sense of someone first job out of college that they offered some sort of a retirement plan and you didn't realize that you were eligible or enrolled in it, or you did know because you get a statement, but you're kind of like, I'm not really looking at that. I know the statement's there, retirement's so far out, but it's money that
Are
you
you
can
quoting me?
consolidate. And not at
Are you
all.
quoting me? Are you
That's not at
sure?
all. That's that's just a general statement. But I think it's important. I think it's one of those that it can be any dollar amount. And I find it more exciting when I talk to young individual investors that are excited in their young 20s and see this great opportunity of time on their side. Because, as we said, a blink of the eye, and I'm 25 years in, but
Oh my
I've
goodness.
now dealt with multiple generations of families because of those factors. And there are more people than not that are very novice, but that's what we're here for, is to see that this is an opportunity for people to create independence, financial freedom, and flexibility in their lives over the course of time.
I love it. As an expert in the field, because we know like things out on the internets are like a lot of boo poo poop. So as an expert, are there people that you follow that you think give good business advice? That maybe if there's podcasts or books out there that if someone's not, they're not an expert financial planner, but something they just want to learn about, they want to learn about compounding. Are there people, I guess that would be like financial influencers that you think are
Right.
actually good or that you respect?
So our chief investment strategist, Liz Ann Saunders, and Kathy Jones, who's our managing director of fixed income, they have a podcast I listen to, and they do quite a bit of educating just about the markets and the economy. So the items I listen to much more often than not, and the calls that I'm on much more often than not, are primarily Schwab oriented or their mutual fund companies that we're associated with. So mine are, I think, are a little bit more biased in that way. But I do think there are fantastic out there. I'm trying to think on some people have asked me about others in the past, and I've always looked them up, and I usually give a green light to most of them as long as they're not trying to sell a product. But there isn't a standout that I would say.
Well, I think
Like
people
as a
either like love or hate Bill Ramsey. Like I think people are like, I don't agree with his terms, and other people are like, yeah. So like he's always one that I'm interested in how people in the financial world feel about his advice.
Yep. I'm kind of it depends on the subject because
Uh-huh.
there are certain pieces that I do believe and I strongly support what he's saying, but there are others that I don't necessarily follow in the same way. I go back to the same factor of making sure that there isn't any bias that's involved in any of the recommendations,
Right.
and I found a few items that I've been a little uncertain about for the most. But he also discloses it too, by all
Yeah.
means. But a few things where I've kind of scratched my head and I'm like, this seems a little bit too much like a product sale, which I don't love. But I have a cousin of mine that he's a huge follower, and he sends me probably once a month. He sends me something on an article on Ramsey that I'm like, let me take a look, and then I respond or I give him a little more like, why don't you think about this piece
Research
too?
this a little more. Yeah.
Yeah.
Well, this is super, super, super fun. I always love learning from you.
Thank
So
you.
Sandy and I are going to live in a compound when we're all retired, and I'm just going to be responsible for keeping everyone fit and healthy. And Sandy will be responsible for making sure we can afford the housing we live in, and we
Yes,
get to live on the
exactly.
beach. So this is going to be like our retirement plan. We've already got it planned out. So, well,
I already
thank you,
sent I
Sandy,
sent you
so
the
much.
most recent one. I sent you one
You
last
did.
week
I
too.
love
Yeah,
it. I just have
yes.
a file in Instagram of like where, and my camper van will fit perfectly outside. It'll be great. So,
And our dogs,
and our
yes.
dogs, exactly. So, well, thank you so much for all of you are a wealth of information, pun
Thank
intended. And I can't wait to bring you back for another episode. Thanks so much.
Anytime. I would love it. And I will look at, you know what I'll even follow up with? I might have a few Schwab items that I can share that you can share even as attachments.
Awesome.
Um,
We'll link those
just
up in the show notes. And until next time, my friends, bye for
awesome.
now.